Joining us here at Post 9 is Apollo Global Management Chief Economist Torsten Slok. It's great to have you back, Torsten. Welcome.
Thanks, Carl. Thanks, Courtney.
So some slowdown, but just not happening quickly enough. Is that the view?
Well, I think that this was a report that basically told the message of this sounds like a soft landing, but with high inflation. So the consequence is that the Fed would look at this and say, well, we're still trying to get inflation down. It's still sticky at around 5% core PCE. With that backdrop, we just got to keep on hiking rates. And there's a number of things in the report that do look like a little thing that's slowing. In particular, the headline non-farm payrolls is coming down, but it's just not happening quick enough. In particular, not with the backdrop of several things reaccelerating. Housing is reaccelerating. Autos have been coming back. All these cyclical components risk making inflation more sticky and therefore making it harder to go the last mile from 5% down to the 2% target.
You think the second half of the year has the possibility of inflation scares?
I do think that there is a risk that if the market now says, well, this is all over, we had a banking crisis a few months ago, and now housing is looking better, and now autos are looking better, a lot of the cyclical components look better, hey, maybe the worst is over. But the Fed would take the complete opposite conclusion and say, no, the worst is not over. In fact, we're still at too high inflation, and that's what we need to deal with.
There seems to be some signals that the consumer is potentially slowing down, that maybe Fed policy is finally working to damp down some spending. That being said, there are others that say actually consumers have sort of taken inflation in, they're dealing with it, and they're still buying when they have to.
Yeah, and that's absolutely the case, because what you think about what's going on is that services is still very strong. There's still very strong demand for the 80% of GDP that is restaurants, also has anything to do with airlines, hotels, all those things that are sort of revenge travel, revenge pickup after the COVID and the pandemic situation. And all that now, of course, is still doing reasonably well. The only issue is that if you begin to look at what's happening to delinquency rates, delinquency rates on credit cards have been going up, delinquency rates on auto loans have been going up. And if the Fed is not going to cut rates, where will those delinquency rates be even by the end of this year? So there's a lot of things on the consumer side that are beginning to look weaker. And that is certainly a crack in this story that everything is fine.
Yesterday, Lori Logan had said she believes that housing has bottomed, and you talked about it reaccelerating. Are you also in the camp you believe that we've bottomed with housing?
See, the issue with that is that housing makes up 40% of the CPI basket. So if housing makes up 40% of inflation, it will probably come down in the next few months because of all the technicalities with how it's calculated in the CPI. But if housing really truly sees a recovery here, and we're seeing traffic with respect to buyers is going up, existing home sales, new home sales is going up, home builder confidence is going up, home buyer confidence is going up, the number of offers that are bidders per home that are sold also is going up. So all that points to that if we have more demand in the housing market, we could run the risk, to Carl's question, that inflation could not be coming down as quickly to 2% as we all would like.
So your house view is a hike in July, right?
Yes.
And then a hike in September?
Well, we're still watching very carefully. We'll get CPI inflation next week, and it will probably on the headline come down. But core inflation, which all FOMC members keep on talking about, is still not coming down. As Jay Powell said at the last press conference, we have simply not made any progress at getting core inflation down over the last 6 months. It's still 4.6. It was 4.6 6 months ago, and their target is 2. So they will come to the conclusion that we've got to do more. So the conclusion for markets is rates are going to stay high for much longer than markets are currently anticipating.